Okay. Okay, so good morning, everyone. Thank you for joining us today. My name is Kelly Shepherd. I'm a payment services partner at BDO, and I'm joined today by my colleagues Luke Patterson, who is a partner within our advisory team and leading the safeguarding proposition, Giovanni Giro, who is an associate director within our advisory division, who regularly acts as an SME on safeguarding within internal audit and Section 166 engagements, and Tiana Ravaranjan, who is a manager within our advisory team and undertakes multiple safeguarding engagements. Just before I get on to the housekeeping, just to let you know, if I do drop off, because my technology is a little bit iffy sometimes on Zoom, Luke will be stepping in, so please stay online. So in terms of housekeeping points, so today's webinar is going to be recorded and we will be circulating the slides and the recording in a few days' time. Your lines will automatically be muted throughout the webinar. And please do submit your questions to the panel throughout the sessions using the question and answer function. We will actually just be doing the question and answers at the end once everyone has spoken, but please do put them on as you think of them as we go through, and then we can pick them up and answer them at the end for you. Today we'll be covering an overview of safeguarding audit requirements, safeguarding from a regulatory perspective, market insights and lessons learned. So first of all, over to you, Tiana. Thank you.
Perfect. Thank you, Kelly. So I'm initially going to touch on the background, which has then got us to where we are today, and the requirements for an audit and what this actually means and looks like. So payments and e-money products have existed for a while. However, they have historically been quite fragmented and difficult to monitor, with different approaches, products and oversight globally, as well as little consistency between these. So the diagram on the slide shows how this has evolved over time, and particularly over the last few years. The first version of the payment service approach document was issued in April 2009 on the back of the payment service regulations. And in 2011, a separate e-money approach document was produced on the back of the e-money regulations. In September 2017, both of these documents were merged to reflect the changes brought about by the introduction of PSD2 and the revised Payment Service Directive, and as well as other changes that we had seen in the market, including the PSRs being updated. So since 2017, we've seen a few updates made to this approach document, with version 4 being last updated in June 2019 and reflecting the most up-to-date version. I think it's fair to say since then the FCA has continued to review how well firms are meeting the safeguarding requirements in practice. And since the approach document, we have seen several published statements, guidance documents and consultation papers, as you can see on the slide. And this included in May and July last year. After initially a brief consultation, further guidance was published clarifying the FCA's expectations of firms' prudential risk management and safeguarding practices in response to the coronavirus pandemic. In January of this year, a further consultation paper, CP 21.3, was published, proposing changes to the approach document, as well as reflecting the UK's withdrawal from the European Union and the end of the transition period. The expectation on the back of both of these is that a full consultation would be occurring later on during this year. So I haven't touched on the Dear CEO or Dear Compliance letters, as Giovanni will run through these in a bit more detail later on. However, it's worth noting that hot off the press last week, a further Dear CEO letter, specifically focusing on the EMRs, was released, that requires firms to write to customers within 6 weeks of the date of the letter to remind them how their money is protected through safeguarding, and that FCS protection does not apply. So on the next slide, I just wanted to touch on these 3 publications in a bit more detail. So firstly, the FCA approach document, and this describes the approach to implementing the PSRs, the EMRs, and the small number of payment service and e-money rules within the rulebook. Chapter 10 of this document focuses on safeguarding and provides guidance from a practical understanding of the requirements and the regulatory approach, as well as how businesses can comply with the requirements. It's worth reiterating that this document is guidance and doesn't illustrate the only ways to comply with the relevant requirements. So as mentioned, in light of the impact of COVID-19 on firms' business models, additional temporary guidance to the industry to strengthen firms' prudential risk management and arrangements for safeguarding customer funds in this period of economic stress was released. And this further clarified ways that firms could comply and included discussions on record keeping and reconciliations, the use of safeguarding accounts and acknowledgement letters, including the selection, appointment and reviewing of third parties, when the safeguarding obligation kind of begins, and treatment of unallocated funds, as well as annual audits of compliance, and also looking at prudential risk and things like wind down plans. CP 21.3 then proposed making permanent this temporary guidance and discussed changes to the approach document as well. And these focused on 4 main areas, one of which being the prudential risk management and safeguarding, and included further discussions on, again, the safeguarding accounts, ensuring appropriate designations of these, the documentation and rationale for reconciliations, and ensuring that these are appropriately documented and all decisions are documented, as well as use of the insurance or comparable guarantee method and annual audits of compliance with safeguarding requirements again. And that last point takes us nicely onto the next slide, where we discuss the expectations for an audit in more detail. So Regulation 25 of the EMRs and Regulation 24 of the PSRs initially set the scene here in terms of accounting and auditing in respect of the provision of payment services. And this was further then expanded in the initial communication set out in Chapter 10 of the approach document, which outlined the requirements for a firm's auditors to tell the FCA if it has become aware in its capacity as auditors of a breach of any requirements imposed by or under the PSRs or the EMRs that is of material significance. The subsequent guidance document then further clarified that the expectation is that firms are required to arrange specific annual audits of its compliance with the safeguarding requirements, if it is required to arrange an audit of its annual accounts under the Companies Act. And this specified that it should be carried out by an audit firm or by another independent external firm or consultant who should have the appropriate skills in auditing compliance with safeguarding requirements. It's also worth noting that this doesn't specify that it should be carried out by a specific firm, so the same firm as the external auditors. In terms of then the resultant opinion, the expectation is that this is addressed directly to the firm and attests to whether the firm has maintained organisational arrangements adequate to enable it to meet the FCA's expectations of its compliance with the safeguarding provisions of the PSRs, the EMRs, as set out in Chapter 10 of the approach document, and that this covers both throughout the period and as at the period end date. Although we have seen exceptions being made to this, but only after agreement with the FCA. So in terms of what this then means and what an audit looks like, on the next slide, we can see a few kind of boxes that I just wanted to quickly cover. So firstly, reviews are conducted under ISA 3000. So this is generally applied for audits of internal controls and compliance with laws and regulations. So in this circumstance, being the compliance with the safeguarding requirements of the EMRs and the PSRs as set out in Chapter 10. This type of review allows for two types of assurance engagement. So a reasonable assurance engagement or a limited assurance, with the objective of reasonable assurance being a reduction in the engagement risk to an acceptably low level to provide sufficient appropriate evidence to express a positive opinion on the company's compliance with the safeguarding requirements. In contrast, the limited assurance engagement is a reduction in the engagement risk to an acceptable level for the circumstances of the engagement, but where that risk is greater than for a reasonable assurance engagement. And that's the basis for a negative form of expression. So similarly to how this has been applied for CAS historically, a reasonable assurance engagement would be undertaken for firms who hold relevant funds, with limited assurance engagements being undertaken to attest for those who don't hold or transact relevant funds. Following on from the completion of our work, there are three deliverables that we would issue or receive back in return. So the opinion, the management letter, and the representation letter. So for the opinion, it is our responsibility to provide a conclusion on whether the company has maintained organisational arrangements adequate to enable it to meet the FCA's expectations of its compliance with safeguarding requirements. And within this, there are three conclusions that are permissible. So a positive opinion, whereby, in our opinion, the company has maintained organisational arrangements adequate to enable it to meet the FCA's expectations of compliance with safeguarding requirements. An except for opinion being whereby, in our opinion, except for the breaches listed in the breach schedule, the company has maintained organisational arrangements. And this is the most common opinion, as the expectation is that all firms will have breaches similarly to CAS. The third and final type of conclusion is a qualified opinion, whereby, in our opinion, because of the significance of the items described in the breach schedule, the company did not maintain organisational arrangements adequate to enable it to meet the FCA's expectations. And I think for the last two, I mentioned the breach schedule, and this will be appended to the opinion and will include all breaches identified by both firms as well as ourselves as well. So in addition to the opinion, we would also produce a management letter, which would be provided and should be read in conjunction with the safeguarding report and breach schedule. And this will set out additional information relating to the safeguarded breaches, as well as bringing out wider observations that we note during our work, and recommended actions to help remediate these gaps. The final document which we would request from management is the representation letter. So this would include various breaches, essentially confirming the completeness and the accuracy of the information obtained during the audit. So now, in terms of the audit scope and what this actually looks like, on the next slide, we touch on the five main areas here. So under ISA 3000, no detailed guidance is included on the performance of the engagement, thus implying that it's down to auditors to use their professional judgment to define the scope and the amount of controls and the testing methods used. So as a result, we have developed a standard audit approach derived directly from the Chapter 10 requirements and focuses on the five main areas. So governance and oversight, safeguarded funds, safeguarded methods, reconciliations, and the impact of insolvency. So I just wanted to touch on these in slightly more detail here. So in terms of the governance and oversight, this covers the organisational arrangements that are in place, including ensuring that there's a documented rationale and approach, so in the form of policies and procedures, as well as that also appropriate oversight exists and appropriate individual has responsibility for ensuring this compliance. We would also look at the training provided and MI and reporting that occurs to relevant committees, as well as the breach process, so including the identification, the reporting and the escalation of these. The second scope area is safeguarded funds, so looking at the identification of relevant funds and that appropriate consideration has been given to where the safeguarding obligation starts and finishes. Safeguarding method, as the name suggests, here we will look at the methods used within the safeguarding process, as well as also the use of safeguarded accounts, so ensuring that appropriate designation exists on the bank letters and that appropriate due diligence has occurred on the banking partners and providers. In terms of the timeliness and the process of safeguarding reconciliation, so this will look at the underlying reconciliations, including the timeliness of these, as well as the timeliness remittance of funds once this has occurred. We will also look at the ITGCs relevant to safeguarding, so any of the systems that are in place, including, for example, looking at the systems involved in the extraction of relevant funds. The fifth and final scope area is the impact of insolvency events, so an assessment of the business continuity plans in place in respect of safeguarding, so would include things like reviewing the wind down plans that are in place. So I'm now going to hand over to Giovanni, who's going to touch on some of these from a reg perspective and touch on these in a bit more detail.
Perfect. Thank you, Tiana. Good morning, everyone. So following from Tiana's session, I just wanted to recap some aspects of what we have identified as key areas or key aspects that we want to focus on today. And it's mainly based on the publications that the FCA has issued, but also our observation of their increased focus on the supervision of payment services and money firms in terms of compliance, but particularly focusing on safeguarding processes. This is very much due to the fact that there's an increased presence of non-bank payment services in industry, and the development of multiple providers and multiple services has increased the FCA's attention to how these firms are actually offering services to customers. The main concern that the FCA has is that non-bank payment services provide basically the use of accounts that are quite close to standard bank accounts, but they actually go under a different legislation from the deposit-taking activities. And also they don't have the same level of protection from the Financial Services Compensation Scheme. So these considerations, including, of course, the pandemic, have raised the FCA's interest in safeguarding processes within firms, risk management arrangements, and governance arrangements in these areas. The publications that Tiana has mentioned earlier includes some key ones that we want to recap, showing the regulation or the regulatory activities that the FCA has actually taken action on, and particularly feedback statements that confirm that some temporary measures that they have actually proposed throughout the pandemic are meant to become permanent in due course, and this was confirmed in the latest consultation paper as well. But also we want to focus specifically on DSCO letters and their compliance letters that have been addressed directly at firms, highlighting weaknesses that the FCA has identified in industry through their thematic reviews and specific requisitions within firms. And the hot topics that come up quite frequently actually include, well, widespread issues with segregation methods and the way firms are actually protecting relevant funds within safeguarding accounts, the processes in place in case of insolvency, reconciliation processes, including the frequency of these, but also the firm's understanding of how reconciliations should be done, the designation of safeguarding accounts, and then ultimately, just last month, the final kind of DSCO letter confirming that the FCA wants firms to communicate quite clearly and transparently about the lack of FSCS protection to their clients. So quite direct messages that the FCA has actually issued throughout, well, the last couple of years, but even more intensely in the last few months. In parallel, supervisory activities have increased as well. So, like I said, the FCA has taken action over time to make sure that they can monitor industry quite closely, but they've used different tools to do that. So, standard thematic reviews that are quite common, but also direct requisitions within firms. So, like I said, we've seen quite a lot of direct requests for information and for written evidence that firms have policies and procedures and processes that are fully documented and described in detail as to how firms do safeguard relevant funds, but also requests for individual documents like a wind-down plan or a specific kind of sample of reconciliation processes. So quite some focus on the hot topics that we want to pick up, particularly in this session. Of course, amongst the supervisory tools that the FCA has, we also have a skilled person reviews. And as Kelly mentioned earlier, I mean, we have plenty of experience of this, and we have seen action being taken also in the payments and e-money sector from this angle. The point is that Section 166 is, of course, very intrusive, very expensive, and could also lead to enforcement. So seeing so much action from the FCA in this area has also demonstrated how seriously they're taking their approach to the supervision of payments and e-money activities. So on the next slide, Lauren, we have basically the three hot topics that we wanted to pick up amongst all the ones that have been identified as kind of the weaknesses that the FCA has brought up through their monitoring. Wind-down planning. So wind-down plans are something that now the FCA expects from pretty much all firms in industry, including banks, investment management firms. But more specifically for today, we're talking about APIs and EMIs who need to have a fully documented wind-down plan that includes both a solvent and an insolvent scenario. So firms need to consider how they can orderly close down the business and return all relevant funds to their clients without disruption to the service, and making sure that the protection of relevant funds is guaranteed. But also they need to include an insolvent scenario, and this is quite key for the reasons we mentioned earlier. So the lack of FSCS protection means that a firm will need to potentially appoint an insolvency practitioner to actually run the process, but at the same time ensure that the safeguarding processes are aligned to make sure that relevant funds remain protected throughout the process. The structure of the wind-down plan is pretty much prescribed by the FCA in a dedicated source book, which is the wind-down planning guidance that they have in their handbook. And it basically determines exactly what content and what layout the plan must have. That includes a scenario analysis, including realistic trigger events and thresholds, recovery options to demonstrate that the firm has, again, business continuity and recovery options available to make sure that the business comes back from potential financial strain. But also all the elements of the governance and decision-making throughout the process, as well as an impact assessment that determines both the impact on the non-financial and the financial resource aspect. And finally, there must be a communication plan in place that basically allows the firm to communicate openly to their own staff, but also to clients, third parties, and the regulator as soon as they decide to trigger a wind-down plan. The key thing of wind-down plans is that they need to have a fully detailed operational kind of step-by-step process fully described. And that means that firms need to pretty much understand how the process will work from beginning to end, including what resource will be needed, who will be the key personnel that needs to remain in place in order to actually run the process to the very end, but also have a clear understanding of the instructions that need to be basically given to those people. Financial analysis and worst case scenario need to be included, and determine also what unexpected costs a firm might incur if any of the steps that are in the plan might not take place in the way that they envisage. So there must be an element of worst case understanding and worst case stress testing embedded within the wind-down plan. Ultimately, firms need to hold sufficient liquidity resources to meet the cost of wind down, But also, almost more importantly, the FCA wants firms to have full control of the process, like I said, from beginning to end. So the operational description of it is key to this. The second hot topic we want to pick up is reconciliations. So reconciliations are basically the process that Tiana mentioned earlier, where firms need to basically identify what amount of relevant funds they are actually basically safeguarding on behalf of their clients, and determine that the amounts they have in safeguarding accounts or covered by insurance are sufficient to make sure that they are fully protected. So reconciliations are important, particularly where a firm is using the segregation method, of course, where firms need to ensure that the cash that they hold meets the entitlement to relevant funds that clients have. And the FCA expects that this must be done as frequently as appropriate, but also as frequently as the risk management process within a firm has determined is appropriate. So high volumes and specific types of activities within the e-money and payment sector will potentially trigger higher frequency of reconciliations. The FCA would normally expect daily reconciliations to be most appropriate in pretty much all businesses. But again, there might be an assessment that comes to a different frequency within firms. Quite importantly, the two elements of reconciliations include internal reconciliations and external reconciliations. Now, these are basically defined quite clearly by the FCA in their approach document, and it's important for firms to have a clear understanding of what each one means. So these are two aspects of the full reconciliation process that need to be clear and fully documented. Internal reconciliations basically look at the entitlement of e-money holders and payment service users where the firm has identified through their own internal records and compare that with the internal records of the amounts safeguarded. So the internal reconciliation process really focuses on internal accounts and records that the firm holds to recognize exactly what relevant funds are to be safeguarded on behalf of their clients. Separately or well, in sequence, external reconciliations need to be done in order to reconcile the internal accounts and records with records of external providers or external third parties where the safeguarding of relevant funds is actually taking place. Basically, internal records of the firm with bank statements of the bank where the relevant funds are segregated. The two steps could potentially go into a single reconciliation process that covers both, but the important thing that the FCA has mentioned a number of times in the DSO letters and other publications is that firms need to have clear understanding of internal reconciliations and have a detailed description in writing of the processes and demonstrate their ability to actually run the two stages of reconciliations in full. Eventually, the process determines that there must be no commingling, but also that there must not be kind of excessive funds held in safeguarding accounts. And that means that firms at the end of the process will be able to make bank transfers to bring the amount of relevant funds segregated in safeguarding accounts to the most kind of accurate closeness to the entitlement of e-money holders and payment service users. Finally, safeguarding accounts. So this again is another hot topic that has come up in different publications, and this has to do basically with the accounts that a firm actually sets up with authorized credit institutions to actually hold relevant funds fully segregated. So the key aspect of this is that those accounts need to be clearly identified as safeguarding accounts, and that means that they need to be named and designated quite specifically so that there's no confusion as to the purpose of those accounts. The FCA basically prescribes the use of specific terminology in the identification of those accounts as safeguarding or client or customer accounts so that both the bank and the firm are clear as to what those accounts are for. If any of that kind of terminology cannot be used for any reason or is not necessarily in place for other reasons, there must be acknowledgement letters exchanged between the bank and the firm that demonstrate that those accounts actually have the pure purpose of safeguarding relevant funds on behalf of the firm's customers. This has to be clearly stated, and the FCA has also provided a specific template of acknowledgement letters that firms are encouraged to use. Of course, there might be instances where this is not necessarily in line with exactly with the FCA template, but there must be sufficient description to determine that basically the bank where the accounts are held has no rights on the relevant funds held in those accounts, except in insolvency events. In relation to safeguarding accounts, one important thing is that firms need to make the selection of the credit institutions that are appropriate for that function at the beginning and basically run the appropriate due diligence for the selection. But more importantly, they need to regularly review the appropriateness of those banks. And this is a process that needs to be fully documented, and firms must be able to provide evidence that the due diligence is an ongoing process over time. If any information on those credit institutions is not available to determine the quality or again the credit rating of those, then the FCA expects firms to run enhanced due diligence, which means that firms will need to make every effort to actually collect and retrieve information about those banks to make sure that they are appropriate for the function that they're there for. So if we jump to the next slide, please. We basically wanted to just highlight some of the key weaknesses that we have identified ourselves in these three key areas. And these come from our relationship with a number of firms in industry, and again, some points that have been actually also confirmed by the FCA. And in particular, with wind-down plans, we've seen that sometimes are not fully documented, but more importantly, some firms do not consider that the insolvent scenario is essential, or potentially they miss the fact that it is required in the wind-down plan. And as we said, this is quite key. Lack of consideration of key persons and relevant costs. This is one of the factors that needs to go into a wind-down plan to determine exactly, again, who will be essential to the process from beginning to end and needs to remain in place and take action until the conclusion of the process. And then a lack of description of safeguarding arrangements in case of business transfers. So some firms have determined in the wind-down plans that one of the immediate options that they have is the transfer of their client base and relevant funds to other regulated firms. This can happen very smoothly, but the wind-down plan still needs to describe exactly how the safeguarding processes will ensure that the full protection of relevant funds is guaranteed in the transfer of business. With reconciliations, I mean, one of the key aspects is the confusion between internal and external reconciliation. And again, this is a matter of kind of technical understanding of what the FCA has basically prescribed as a clear distinction, but also having the processes fully documented so that there's clarity as to when internal reconciliation begins and ends and when external reconciliation begins and ends. Frequency of reconciliations sometimes not being appropriate to the risk posed by the business. Again, this is a matter of internal assessment by the firm, but as we said, the FCA has a broad expectation of daily reconciliations. And then sometimes inaccurate record keeping. Record keeping is a key requirement that comes directly from the regulation, and the FCA has always determined that basically for the purpose of supervising firms, having everything fully documented and fully described is a key factor. And finally, safeguarding accounts. So we've said just now what kind of the requirement is and where the FCA has identified weaknesses. So from our point of view, sometimes there might be lack of client designation. And again, there might not be the right kind of terms used in order to identify those accounts. But also sometimes we have experienced firms that have safeguarding accounts held at banks that are non-UK and potentially European banks or foreign banks that use different terminology. In this instance, again, the acknowledgement letters and the terminology used must be clear as to the rights that the bank has on those accounts and those funds, but also the purpose of being for safeguarding purposes only. And finally, the lack of regular due diligence and regular reviews. So firms, like I said, have an obligation to actually make sure that the banks they've selected remain appropriate, and they need to run regular reviews of that appropriateness. So these are just the key points we wanted to focus on, but I'll hand you over to Luke now, who will cover the third part of the session.
Hi there, thanks very much, Giovanni. So what I really wanted to cover with you today was around what we're seeing in the market, where clients are on their journey to safeguarding, some lessons learned, what we've seen in this space, both some good positive areas, as well as some areas that our clients are kind of focusing on. We also wanted to look at kind of the expected state of safeguarding going forward, which I'll cover in a second. So start with market position. So Tiana has shown kind of the progression of safeguarding over the past few years. And where we are now is there's a clear increased focus on safeguarding, especially due to COVID, and increased focus on payments and the e-money or the e-money industry by the FCA generally. Specifically talking around safeguarding, we're seeing firms are really in varying stages of their development or their progression through the safeguarding journey. So if I take a step back 12 months, firms were generally using internal audit or other advisors to review the safeguarding controls and processes against the approach document. This resulted in a number of remediation actions. It's taken a number of months for firms to either fully remediate, and they're kind of coming to that journey's end at the moment, or they're kind of halfway through that remediation process. And some firms are actually starting to think about the requirements of safeguarding and how to address kind of fully the approach document. But ultimately, a lot of the timing is very much dependent on the financial year end. So, there's generally an accepted lack of clarity in fully understanding the expectations from the FCA around the scope. Because a lot of firms, both industry as well as practice, are looking at it through the lens of CAS, but there are clear differences between CAS and safeguarding. One just being the need for an advisory report rather than an audit report. Another good example, and Tiana covered this, was around the framework used. So the ISA 3000 framework is an advisory framework. Now, this throws up a number of challenges that are being discussed and actually going back to the FCA for clarity. Some of those are around actually clear direction and guidance on what to look at in relation to safeguarding. And if you compare that to, say, for example, CAS has a 94-page document, which gives you a lot more guidance and clear direction on what you should look at. It's around kind of the level of testing required, the framework used. I think the ISA 3000 is generally an accepted framework based on the current approach document. And actually, the question is being asked, is the market ready for safeguarding? Tiana mentioned that there's been a lot of documentation coming through over the number of years, and actually it's increased recently over time, mainly due to COVID. But actually, is the market ready for it? And that question is kind of key. And also, the other big issue is around timing of reports. So the requirements talk around kind of the period end date and over a period of time, but it doesn't define what those are. So guidance and documentation around that is needed. But ultimately, the aim of all of this and all of this additional guidance is to try and bring consistency across the market for when firms are performing these audits, because that's important. So just moving on to the second point around lessons learned. Generally we've seen over the past few years doing these audits, there's been some real positives. I've noted here a few around kind of good documentation, good gap analysis against the approach document. Firms are really defining what their kind of start and end point or their perimeter of safeguarding and the timing and the dependencies required. And that's being documented quite clearly, which is a requirement under the approach document. The second point I've noted around governance arrangements. So this is around kind of taking ownership at a senior level. So a lot of firms are, including this within, for example, treasury committees, or going to board or other governance committees that are currently there, to ensure there's that ownership at a senior level over safeguarding. And also the use of internal audit to almost do that gap analysis against the requirements and remediations. So that's been happening over a number of years. And actually we're seeing firms are taking this very seriously. So there's some real positives there. Some areas that we're seeing firms are still working through. For example, kind of really defining the relevant funds. So, are you in scope of safeguarding? Are you outside of scope of safeguarding? And having those relevant funds defined. Some firms are using solicitors to really define what those relevant funds are. The second one is around use of buffers. Buffers are there to ensure where there's timing differences or where there's others outside of your control, to ensure you are holding the appropriate amount of relevant funds and you're not under safeguarding. Now, really defining why and the rationale why you're using those buffers, firms are still kind of working through. And also the point around training of staff. So what we're seeing is actually that safeguarding, the knowledge of safeguarding requirements is held by either a team or a few specific individuals who are doing the reconciliations, who understand it actually quite well. But it's that wider understanding of teams where, for example, a safeguarding team has dependencies, and actually those dependencies will impact the timing of those reconciliations and hence breaches. It's still working out that training to other teams so they fully understand why they're doing it and what they're doing. So those are some of the key points I just wanted to share. The next point was around kind of future state. There's a lot of discussion at the moment around more guidance is required for safeguarding. Interestingly, the consultation paper that Tiana mentioned, 21-3, made it clear, and I'm conscious it's still a consultation paper, but made it quite clear that there was a requirement to have an annual audit of safeguarding against the safeguarding requirements. The other point that needs to be drawn out on that paper was actually if there's a change of business model. So for example, if you're doing the segregation method and actually you then get insurance against that, an audit is required at that point in time if there's a business model change. So kind of like CAS, there's a requirement to have an annual audit of safeguarding. However, the point in time and the period in question hasn't been defined. So actually what we're seeing is a lot of firms are varying their periods and varying their point in times, ultimately based on remediation that's been happening in last year and the closing of those remediation points. So there's a real, at the moment, there isn't a consistent approach, but actually it's an appropriate approach based on the relevant information that we have at the moment. And generally going forward, my personal view is that actually this more aligns to CAS, but there are nuances in that, in that it's an advisory opinion, not a CAS opinion. But ultimately, we would expect there to be a lot more guidance coming out from the FCA on what their expectation is. Those are some of the key points I just wanted to cover. I'll pass you back to Kelly, and we're happy to take any questions if there are any. Thanks so much.
Thanks, Luke. So I think, as Luke said, that was sort of the end of our sort of formal presentation part. So I was conscious that we obviously said we would do some question and answers at the end. So I've got a few questions that have popped up, and if anyone else has any more, please do put them into the Q&A section. So I think the first question is, that someone's asked is, what are the key differences between CAS and safeguarding audits? Luke, I think you've kind of just touched on some of that, but maybe you want to take that one and answer a few more bits.
Yeah, sure. Thanks, Rob Kelly. So the interesting point is, so the key point really is that it's an advisory engagement. It's not an audit opinion. As a result, the framework under use is slightly different. So part of the key difference on this at the moment is that the ISA 3000 is framework that is used as an advisory framework. The key point of that is the scope of the engagement is not defined within the ISA 3000 framework. So ultimately, at the moment, you could be in a position where you have slightly different scopes across the market for different clients, because effectively you're utilizing or you're defining the scope as you define kind of the planning process. It's quite clear the requirements require you to align it to the chapter 10 of the approach document. But in that, there are some nuances around, for example, wind down plans. So the chapter 10 requirements only, the last, I think, two or three paragraphs talk about wind down plans, but they link back to further additional kind of information on wind down or other requirements on wind down. So it's effectively how far do you go? The other question is around kind of the level of testing. And hence kind of the CAS requirements are quite clear on what you should test and how you should test it. The ISA 3000 is more kind of, what's your sampling approach? How many do you sample? Where do you draw the line? And you might get slight nuances between the, different firms doing the audits. Those are just some of the key points that I wanted to raise.
Okay, thank you very much, Luke. So the next question that we've had in is, what do you think are the key steps to good safeguarding? Giovanni, I think that's probably one for you.
Yeah, sure. Thanks, Kelly. Good safeguarding. Yeah, I mean, that's a very good point. I mean, we basically want to make sure the firms have the standards that are acceptable for the FCA. So the best way to do that is follow what the approach document says. The approach document that the FCA publishes and renews regularly is the main place where they give kind of instructions to firms as to how they expect them to do, safeguarding, but also they run that governance, risk management, and prudential requirements. So that's definitely the best place to start from. Key steps mainly includes having a solid governance structure and solid governance processes, but also risk management to support all the processes that are in place in a firm. So everything must be driven by the kind of nature of the business, but also the risks actually posed to the business, so that everything the firm does is actually proportionate to that. The key thing that the FCA expects of firms is having written evidence of pretty much everything. So maintaining written policies, having fully documented processes. This is key for them to provide the evidence that they have the right approach to safeguarding. But also for the FCA to be comfortable that they can simply request information from firms and be sure that the right controls are in place within firms. And then, as we mentioned earlier, there are regular publications by the FCA focusing on specific hot topics or weaknesses that they've identified in industry. If firms are kind of keen to, keep the FCA happy and make sure they're fully compliant, monitoring that level of communication from the FCA is going to be very important, because they will definitely change the focus regularly. Although, as we said, there are kind of recurring themes that the FCA keeps picking up. But again, FCA approach document and FCA publications will be, the best place to understand how to address safeguarding in full to, the FCA's liking and in compliance with the rules.
Okay, thank you, Giovanni. This is an interesting question, and I know there's been a lot of internal discussion on this one here at BDO. What are the requirements in respect of timing of the audits and at a point in time and the period? I don't know if that's sort of Luke and Tiana to jump in on that one. Luke, do you want to start on that one?
Yeah, no, thanks. That's a really interesting question, and currently there is no and I'll be clear, there is no defined requirement. However, there is an expectation that there will be communication or conversation 1 year post the approach document. This is not defined, and the requirements are clearly not defined at the moment. This is I know this is an area that is requiring clarification that has gone back to the FCA. So you know, what I can share is what we're seeing is that some firms are treating it very much like CAS. So it's, for example, 4 months post year end for a report. Some firms are actually taking the 1 year post the approach document and aiming, I think, for the beginning of July. Some firms are actually kind of starting to do remediation exercises now. But ultimately, where there's a significant change, I think the communication or conversation is being had from their perspective with the FCA. Tiana, did you want to add anything to that point?
I guess the only other point, and I think as I mentioned earlier on, is that the period is both a period of time as well as a period end date, but we have seen exceptions to this with firms agreeing with the FCA to only cover a period of time. But yeah, that is only after agreement with the FCA.
Okay, perfect. Well, I think that's it for now. So as I mentioned earlier on, the session has been recorded, so we will be distributing the recording and the slides around. If there are any more questions or sort of any further advice on this, then please don't hesitate to contact one of the team here today, either myself or Luke, Giovanni or Tiana. We're very happy to help. So thank you very much for joining us today, and have a good day. Thank you. Bye.